Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rackspace Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock, if you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So imagine a dinosaur. Right now, imagine you're watching that dinosaur just suddenly sprint past a brand new Ferrari.
That would be pretty wild to see.
Yeah, it's a jarring, almost unbelievable contrast.
Yep.
But that is exactly what we are looking at today in the market. I mean, for years, Rackspace Technology has been viewed by many on Wall Street as exactly that, a dinosaur.
Oh, absolutely. A total relic from the early, clunky days of managed website hosting.
Right, it was a company that was slowly fading into irrelevance as everyone and their mother basically migrated to the massive public clouds. The stock had been trapped in this brutal, agonizing, multi-year downtrend.
Yeah, pretty much everyone had just written it off.
Exactly. But then we get to May 7th, 2026, and the chart just absolutely explodes.
Explodes might actually be an understatement for what happened there. We are talking about an intraday surge of, well, over 100%. The stock hit a brand new 52-week high of $4.62 in literally a matter of hours.
Which is insane. But the price jump isn't even the most fascinating part, is it?
No, it's not. What is really crucial for you as an investor to understand is the sheer volume behind that move. I mean, it wasn't just a few enthusiastic retail traders swapping shares on a message board.
Right.
We saw a staggering 193 million shares trade hands in a single day. When you see volume that massive, especially compared to an average day of like around 27 million, that is the undeniable footprint of an institutional re-rating.
It's the big money suddenly waking up.
Exactly. They're deciding that their entire thesis on this company is wrong, and they are aggressively rewriting it in real time. This is not some meme stock pump. It is a fundamental shift in perception driven by a brand new artificial intelligence turnaround strategy.
Okay, well, I have to push back a little bit right out of the gate here, because seeing a 100% jump in a single day, that sets off every analytical alarm bell in my head.
Sure, that's totally fair.
I mean, yes, 193 million shares, it's an absolute tsunami of volume. But we have to ground ourselves in the mechanics of how the market actually works. This is a company that has been relentlessly punished for years.
Right, highly shorted.
And when a heavily shorted, distressed stock suddenly gets a single piece of good news, like this new AMD partnership they just announced, you almost always get a massive short squeeze.
You do. That's a classic setup.
Let's break that down for a second. You have all these institutional short sellers betting the company will go bankrupt. Suddenly, good news hits, the stock ticks up, those short sellers panic, and they're forced to buy the stock at any price just to cover their losing bets.
Which creates an artificial, super violent price spike.
Exactly. So the guiding question we have to answer today is this. Is this just a temporary violent short squeeze that is inevitably going to fizzle out? Or are we actually witnessing the beginning of a legitimate, sustainable recovery?
It really is the billion-dollar question. And to figure out if this violent surge actually has legs, we need to understand how a distressed asset fits into a broader investment strategy. All right, let's move into the wealth-building context.
Because when we talk about building wealth with a stock like this, we aren't talking about a safe, dividend-paying blue chip, right?
No, exactly. What we are looking at here is the classic setup for what we call asymmetric upside.
Okay, explain that for people who might not be familiar with the term.
Sure. It happens when a company transitions out of a secular decline, which means their entire industry was structurally shrinking, and moves into a phase of mix-shifted growth.
Got it.
The asymmetric part simply means the potential reward is significantly larger than the potential risk. I mean, the market had already priced Rackspace for near bankruptcy.
Right. The worst-case scenario was basically baked into the stock price already.
Exactly. But the best-case scenario wasn't. And that best-case scenario is their brand new competitive moat, which they are calling Governed Enterprise AI Infrastructure.
Governed Enterprise AI Infrastructure.
Yeah.
I mean, that sounds like the kind of corporate buzzword soup you hear at a tech conference.
Oh, it definitely does.
Let's translate that into plain English for the listener. Why is this actually a moat?
Because it solves a massive, incredibly expensive problem. Think about highly regulated sectors like major banks, global healthcare networks, defense contractors.
Okay, yeah.
These entities are desperate to use cutting-edge AI to stay competitive. But they can't just throw all their sensitive, strictly regulated data onto the public hyperscalers.
Right, because if you are a hospital,
Yeah.
you cannot legally dump private patient medical records into a generic public cloud to train an AI model.
Exactly. You have strict compliance mandates and data sovereignty laws. So Rackspace is stepping into this gap and saying, look, we will partner with AMD to build you a private, managed, perfectly secure, and governed AI environment where you retain total legal control over your data.
They're basically building the secure vault for the AI gold rush.
That's a really good way to put it.
I love that. In fact, if you're a long-term investor listening to this, I like to think of this entirely like buying a heavily distressed commercial property.
Okay, walk me through that.
Imagine a massive, older office building in a prime downtown location. But the roof has been leaking for a decade, the old tenants all left, and the market has priced it as a teardown.
Right, which has been Rackspace over the last few years.
Exactly. But now, with this AMD partnership, they are essentially ripping out the walls and putting brand new, state-of-the-art foundational plumbing into this building.
Which is that secure AI infrastructure.
You got it. If you buy in now, you are buying right before the renovation finishes.
That is a perfect way to look at it.
But, and this is a very big but, it requires immense patience and a seriously strong stomach for volatility. I mean, a property mid-renovation can still encounter massive, unexpected costs.
Oh, for sure. The contractor could walk off the job.
Exactly. Or the pipes could burst.
No.
So from a wealth building perspective, this isn't the core pillar of your portfolio. You wouldn't put your life savings into the leaky building.
No, definitely not.
It's a smaller, speculative allocation. You are betting that the renovation gets finished and the new tenants actually move in.
And to see if that renovation is actually on track, we need to inspect the ledger. Now let's look at the fundamentals, because the hard numbers in their recent Q1 2026 earnings report are actually starting to prove that this turnaround is well underway.
Okay, let's walk through that beat.
Total revenue actually grew 2% year over year, hitting $678 million. Now, if you are looking at a high-flying tech stock, 2% growth sounds terrible.
Right, it sounds like practically nothing.
But for a legacy company that was fully expected to be shrinking, stopping the bleeding and posting positive growth is a massive flashing green signal to the market.
Well, the devil is always in the details with these turnaround reports, though. That 2% overall top-line growth is actually hiding a very aggressive tug of war beneath the surface, isn't it?
It is, and that tug of war is exactly what we mean by mix shift. You have to look at the two sides of the business. Their public cloud revenue, which is the modern, high-growth side of the business, surged 7% to $443 million.
Wow, okay.
Yeah, and because it grew so fast, that segment now makes up roughly 65% of their total business. It has grown so large that it is completely offsetting the 6% drop in their legacy private cloud business.
So the old rot in the building is finally being outpaced by the new construction.
Exactly. And the most symbolic victory for the market, they finally returned to GAAP net income. They posted an $8 million profit.
Which is a wild swing from a $72 million loss in the exact same quarter last year.
It really is. Plus, their full-year guidance projects $2.6 to $2.7 billion in revenue, with operating profits expected to expand.
Okay, so the top-line mix shift is definitely encouraging. The legacy business is shrinking, the new business is growing, and the new business is finally the bigger piece of the pie.
Right.
But as an analyst, I can't just look at the income statement. I have to look at the balance sheet. And if we go back to our commercial property analogy, this is where the reality check hits hard.
Oh, the mortgage.
Yes. This building has a massive, suffocating, high-interest mortgage attached to it. Rackspace is carrying a very heavy $2.68 billion in long-term debt.
That is a massive number.
Now, they aren't going bankrupt tomorrow. They have $295 million in total liquidity, and they generated $144 million in operating cash flow over the trailing 12 months.
Which is solid.
It is, but their free cash flow is under severe pressure right now. Why? Because building this new governed AI infrastructure requires massive capital expenditures.
Right, the new plumbing isn't cheap.
Exactly. They spent $35 million on CapEx in Q1 alone, which is up significantly from last year. You just can't build hyper-secure, specialized AI environments for banks and hospitals with cheap 5-year-old hardware.
It costs an absolute fortune to buy those advanced AMD chips and servers.
So they are operating with a very thin margin for error when it comes to cash flow. They are in a race against the clock to get these AI systems built and rented out before the debt catches up to them.
Exactly. The clock is ticking loudly. That brings us to the catalyst timeline, because those heavy capital expenditures are precisely what will allow them to capture the upcoming events that could keep the stock running.
So what's the main event everyone's watching right now?
It's the Memorandum of Understanding, or MOU, with AMD. This is the structural framework for building that governed AI infrastructure we've been talking about.
Right.
The massive binary catalyst that Wall Street is holding its breath for is the signing event. That is when this MOU officially converts into a binding, revenue-generating, definitive contract.
I'm really glad you brought that up because I want to emphasize the word non-binding for everyone listening. A memorandum of understanding is essentially a corporate handshake.
Yeah, a promise to make a deal.
Right. In our real estate analogy, this is the contractor giving you an optimistic estimate and shaking your hand, but no one has actually signed the work order or written a check yet.
That's a very important distinction.
So what happens to this entire turnaround thesis if that AMD deal stays as just a handshake? I mean, if it never turns into actual customer deployment, Rackspace has spent all this CapEx building a beautiful, secure AI vault, and nobody shows up to rent it.
That is the execution risk, absolutely. If the handshake doesn't become a signature, the thesis crumbles. But there are other catalysts in the pipeline providing a bit of a safety net.
Like what?
Well, there's a lot of speculative buzz right now around a potential expansion of their Palantir partnership. They announced the initial framework earlier in the year, and moving that from just a pipeline concept into fully deployed, recognized revenue would be a huge validation of their capabilities.
Okay, that makes sense.
Furthermore, we have to look at macro enterprise IT budget cycles. As we move into the second half of 2026, corporate budgets are heavily focused on AI governance. Regulated companies are actively shopping for these exact solutions right now.
So when do we actually see if they're landing these clients?
We will get our next big read on this during their Q2 earnings in August. If public cloud growth accelerates there, it validates that clients are actually signing on the dotted line.
Well, if we have to wait until August to see if the clients are really showing up, the market certainly isn't waiting around patiently.
No, it definitely isn't. The reaction to these future promises has been violent.
Now let's pivot to the chart, because trying to make sense of a breakout like we saw on May 7th requires looking at the technical price structure.
Right.
I mean, when a stock jumps 100% in a single day, it shatters basically every technical model in the short term.
It truly does. The best way to describe this chart is a capitulation to the upside.
Capitulation to the upside.
Yeah. Usually in finance, we talk about capitulation when a stock crashes, and the last remaining optimistic investors just throw their hands up in despair and sell at the absolute bottom. Here, the exact opposite happens.
The short sellers and the skeptics capitulated.
Exactly. Prior resistance levels on the chart weren't just broken, they were utterly obliterated on the way up. If we look at the moving averages, the sheer momentum is breathtaking.
Just how far above the averages are we talking?
The stock is currently trading an astronomical 178% above its 20-day simple moving average, which sits way down at $1.54. It's 169% above its 50-day moving average of $1.59. And the MACD, which stands for the moving average convergence divergence, had a massive crossover.
Let's give a quick translation for that. For you listening, if you aren't a technical trader, think of the MACD as the ultimate momentum gauge. It measures the tug-of-war between buyers and sellers.
Right.
For years, the sellers were easily winning that tug-of-war, dragging the stock down. A massive crossover means the rope just snapped, the sellers collapsed, and the buyers are suddenly sprinting in the opposite direction.
That's a great way to visualize it. It completely confirms that the historical downside pressure has evaporated.
But that is exactly why I view this specific moment in the chart with extreme caution. When a stock is trading 178% above its 20-day moving average, it is, by historical definition, wildly overbought.
Oh, yeah, without a doubt.
Going back to the momentum idea, it is like a rubber band that has been stretched to its absolute physical limit. It has to snap back. The question for anyone looking to invest right now is, do you wait for a pullback, or does that 193 million share volume mean the baseline price has permanently reset to this new higher level?
It's tough to say for sure.
In my experience, even the most aggressive institutional re-ratings eventually consolidate. Buying at the absolute peak of a 100% daily surge is a recipe for getting caught in a near-term retracement, even if the long-term turnaround is totally real.
That push-pull between the technical exhaustion and the sheer volume is really fascinating, which brings up the question of who is actually doing the buying at these levels. So what does market sentiment look like?
Yeah, what are the big players doing?
Interestingly, there is a massive disconnect right now between Wall Street analysts and actual institutional money flow. The analysts, frankly, are severely lagging behind the price action.
How so?
The consensus rating on Wall Street is actually still a reduce with a price target of just $1.93. Now, RBC Capital did step up and bump their target slightly to $2.50, but they still kept a neutral rating.
That's pretty conservative given the recent action.
It is. However, if you look at a discounted cash flow model, which projects the actual future cash the business will generate, like the one from Simply Well Sentient, it suggests a fair value of $4.32. That's significantly higher than the analysts are willing to admit.
And what about the institutional side?
That's the crazy part. Institutional ownership is incredibly high at over 82%. Major players like Bank of New York Mellon and Janus Henderson were actively buying in during the first quarter.
Really?
Yeah. The smart money is aggressively positioning for the turnaround, even while the sell-side analysts are dragging their feet and waiting for more proof.
Okay, but wait. If we are tracking the smart money, we have to look at the ultimate insiders, right? The people actually running the company. And insider sentiment paints a slightly different, much more cautious picture.
You're talking about the recent stock sales.
Yes. In the last 90 days, there has been significant insider selling. Over 502,000 shares were sold, specifically by the chief financial officer and the executive vice president. Think about that for a second.
Okay, but
If the commercial property renovation is going so spectacularly well, why is the building manager suddenly selling his keys? When the people who literally run the financials are dumping 500,000 shares right around a massive price pop, the skeptical observer have to ask if they are using this rally as an exit liquidity event.
look, I hear the skepticism, and it's a fair observation, but we have to look at the scale of those sales objectively.
Yeah.
Yes, the CFO sold shares, but that same CFO still holds over 2.1 million shares.
That is a large remaining position.
Right. If I had been holding a heavily distressed, sinking stock for 3 years, watching my net worth evaporate, and it suddenly popped 100% in a day, I'd probably sell a chunk and buy myself a boat too.
Fair point.
In the context of a recovering stock that just saw extreme volatility, selling off a fraction of your holdings is completely standard personal liquidity taking. It's just taking a little profit off the table after a multi-year drought. It does not indicate a fundamental lack of faith in the company's long-term direction.
Fair enough. A boat is definitely tempting after a 3-year drought. But while the insider selling might just be personal profit-taking, there's a massive red flag buried deep in the financial footnotes that we cannot ignore. Now let's talk about the risks.
Okay, lay it on me.
Because this is where we have to peel back the layers of that optimistic earnings report and expose the hidden details. Earlier, you mentioned that incredible, highly symbolic milestone of the company hitting an $8 million GAAP net profit.
Yes, the return to profitability.
But there is a massive caveat hiding in the accounting rules. That $8 million profit was heavily aided by a one-time $55.8 million gain on something called debt extinguishment.
That is a crucial detail to unpack.
It changes the entire narrative of the quarter. Let's explain what debt extinguishment actually is. Imagine you owe the bank $100,000 for your mortgage.
Okay.
Because the bank is worried you might go bankrupt, they offer a deal. Pay us $50,000 right now in cash, and we will forgive the entire $100,000 debt. You do it. Suddenly your debt is gone, and on paper, your net worth just went up by $50,000.
Right, it looks like a huge gain.
Exactly.
Yeah.
That's essentially what Rackspace did. They bought back some of their own distressed corporate debt for less than its face value, and accounting rules let them record that difference as a massive gain.
So it's basically a balance sheet win, not an operational one.
Yes. It is a brilliant financial maneuver, but it is an accounting trick. It is not cash generated from selling governed AI cloud servers to new clients. Without that one-time paper gain, the core business operations are still generating GAAP losses.
That's definitely concerning.
And when you pair that reality with the valuation disconnect, you have a company with roughly an $800 million market cap that is currently saddled with $2.68 billion in debt. The execution risk here is immense.
I see what you're saying.
If this AMD AI infrastructure doesn't convert into actual cash-paying clients incredibly quickly, That debt load is going to suffocate them before the renovation is ever finished.
That is the bear case, clear as day, and investors absolutely must weigh that heavy debt load. But here is the counterargument that the institutional buyers are clearly banking on. The market is already pricing this company like a distressed asset.
Even after the run-up.
Even after this massive 100% rally, the stock is trading at just 0.3 times its sales. Because the expectations were beaten down so low for so long, Rackspace doesn't need to dominate the entire global AI industry to succeed.
That's true.
They don't need to beat Amazon or Google. Even modest incremental success in converting that AMD pipeline into deployed, paying revenue provides enough cash flow runway to service the debt while the broader turnaround matures.
Assuming they can actually convert it.
Right, but let's not forget, they still generated $144 million in operating cash flow over the last 12 months. It is enough to keep the lights on, keep the debt serviced, and keep the servers humming while the govern AI thesis plays out over the next few years.
Weighing the accounting tricks, the massive debt, the explosive chart, and the institutional buying. So with everything on the table, what's the final verdict?
Based on the fundamental shift in their business model and that undeniable massive institutional volume stepping in, the bullish score here comes in at a solid 7 out of 10.
7.
Yes. But patience is key. The target horizon for an investor considering this should be a 12 to 18-month hold. You need to give the company the necessary time for the AMD deal formalization to actually be signed, and for the fiscal year 2026 guidance increases to actually play out in the quarterly report.
Right, see if the renovation finishes.
Exactly. Rackspace Technology has successfully and violently pivoted from being a secular loser in legacy hosting to a highly credible, governed AI player. While the debt is undeniably a heavy burden, the stock offers compelling asymmetric upside for those long-term investors willing to ride out the renovation of this particular commercial property.
Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.